So
Okay.
we're taking a look at liquidity.
Okay.
What does liquidity means? It actually means money.
Yes.
That's
When the
what it
big
means.
players come in. Yes.
Yes. They want to tell when they come in, they want to see where the money is and use the money to, should I use the word fund their orders? Excuse me. They want to use the money to fund their orders. Liquidity actually means not just money, it means orders. Where do you have lots of orders in the market? Because if you enter in a place where there are no lots of orders and you are entering a big position, millions or even billions of dollars, it will show on the charts. If, for instance, you want to enter at this position, you can see my cursor.
Yes.
You want to enter here. There's some amount of money you will push into the market at that place that will cause the market to rally up significantly. You get my point? It will rally up significantly. So for you to now buy again at this point
Mm-hmm.
makes sense, will not be profitable for you. So what they do is rather than put in all their positions once, they put them little by little. But even the little by little is big enough for us to see their footprints or see their footsteps in the markets. Are you getting me? So
Yes.
how do we spot valid liquidity in the markets?
Yes. We look
So,
at the higher highs and the lower lows, and we check to see if the market will come back and swipe those areas. Like when you're looking at the one from the higher high,
mm,
you check to see will the market come back and swipe like uh the last higher high.
okay. First, I want to establish some points. The possible areas where we have liquidity in the market are usually in an uptrend, for instance. In an uptrend, we look at liquidity areas always include swing highs and swing lows.
Okay.
Swing highs and swing lows. Swing highs and swing lows. Then we also have where did I go to? Okay, we have swing highs and swing lows. Highs and swing lows. We have which other areas can we look at also for liquidity? We have same highs and same lows.
Yes.
We have same highs and same lows. Same highs and same lows. We also have trend line liquidity.
Yes, it can be some traders they use the trend line to
Yes, they use
yes.
trend line. So also have trend line liquidity. Each other one again. We have trend line liquidity. We have even smart money concepts like Even other blocks. Other blocks, an other block can be liquidity zone. An other block can be a liquidity zone. Even a fair value gap can be a liquidity zone. Even a fair value gap. So other block can be a liquidity zone, a fair value gap. FVG can be a liquidity zone. So what else? What else? What else? Can you help me? Swing highs and swing lows,
Um,
highs and same
um,
lows.
what about a change of character?
No,
You can't. Oh, okay.
no. We can't use that as liquidity points. Okay. We have trend line liquidity, other blocks, fair value gap. Okay. So let me use one term most traders use so much. Support and resistance. Support and resistance. Support and resistance. That's a common liquidity, especially for retail traders. Most of them like trading support and resistance. Most of them like taking their trades on the trend line. So we have liquidity building up around that area. So if you look at my illustration, this is my illustration here. So every in an uptrend, for instance, every swing high and every swing low has liquidity. It has liquidity. Every swing high and every swing low has liquidity. Then here, this is we have same we have same lows here. This low and this low, they are almost the same. They don't have to be exactly the same, but they are almost at the same points. This is same low liquidity. Then around here, we have a resistance. So you can find you can find liquidity here on this resistance too. You can find liquidity on this resistance too. So
Okay.
each other block, so every other block that is also formed along this along these zones, other blocks or supports, you call them support.
Okay.
You can also call them demand and supply. All these other blocks are also positions. An other block here. So all these other blocks are also liquidity zones. So majorly we have we have what we call buy side liquidity and sell side liquidity. I've used those words before. So what's buy side liquidity?
Um. Well, I'm not sure to be honest.
Buy side liquidity. Oh, wow, my thing's flying. Buy side liquidity. Or let me use the word. Let me not use the word buy side. Let me use something that we will remember. Buy stop. Let me use the word buy stop liquidity. Buy stop liquidity and sell stop liquidity. Buy stop liquidity and sell stop liquidity. So in an uptrend, for instance, when you form a swing low here, traders are buying. So what do they put here? Well, they put their stop loss here. The stop loss they put here is a sell stop. Yes or no? It's a sell stop. So under each low in an uptrend, you have a sell stop liquidity.
Okay.
You have a sell stop liquidity. So when traders are buying, they want to put a stop loss under that says, see, I want to buy this position, but in case instead of buying, market decides to sell, stop me out at this point. So
Okay.
that stop loss is a sell stop order. It's a sell stop order. Now, when they are selling at a swing high, usually in a downtrend, that usually happens in a downtrend. You want to sell at a high position and push the markets down. They put a stop loss here that says, see, I want to sell. But in case the market decides to buy, take me out at this position to minimize my risk. The stop order they use here is a buy stop. So this is buy stop liquidity. That's buy
Okay.
stop liquidity. Do you get that?
Yes.
So we have buy stop liquidity, we have sell stop liquidity. So the big players in the market are always targeting this liquidity. And one thing I've seen is that the market is always hunting for liquidity. So it's an algorithm that hunts for liquidity. It goes from one liquidity to another liquidity. See, it goes from liquidity here to hunt for the liquidity here, comes back again. Then majorly, there are two major types of liquidity. We call them external range liquidity and internal range liquidity. External range liquidity and internal range liquidity. I'm going to write that necessary. External range liquidity. Why is my voice echoing? External range. Let me use block letters for that. External range liquidity. External range liquidity. And internal range liquidity. When we're talking about market structure,
Okay.
we talked about the external structure and the internal structure. Did we? For instance, we see one swing guy, let's say this swing guy, but one swing low. So the next swing guy, that is your external structure.
Okay.
Anything between them is internal structure. You remember that?
Yes.
So you have your swing low here, you have your swing guy here. That's external structure. The liquidity at the swing low and the swing guy is external range liquidity. Why all the liquidity between the swing low and the swing high is internal range liquidity. You know that within the swing low and the swing high, we have something like this. Our market is not just one straight line, pushing up, pushing down, then it pushes up. Then in order to form your swing low, market will take out one or two pullbacks. So these are pullbacks, 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 pullbacks. Hmm? So, but this is your swing low, this is your swing high. In order to form your swing high and your swing low, market has to take out one or two pullback. It does a correction.
Okay.
Does a correction. So all this liquidity within the within this structure, liquidity within the structure is called, they are all called the internal liquidity. So market will go take out the external liquidity, takes out the external liquidity here. Then after taking out that external liquidity, it will start seeking for internal liquidity. Are you seeing it? It's seeking for internal liquidity in terms of swing lows, all those small internal swing lows or pullbacks, internal liquidity in terms of fair value gap and other blocks, breaker blocks, mitigation blocks. So price will come and seek all those PD arrays. So what it's doing is not just going to visit somebody, it's going to take liquidity because it needs that liquidity to power the next impulsive move up. It needs that liquidity to power the next impulsive move up. So is this making sense to you?
Yes, it is.
Price will always move from external range liquidity to internal range liquidity. So once price takes out an external range liquidity like this, it takes out this I, this is internal range liquidity. You know that the next move after taking out external range liquidity, the next move is price will start seeking internal range liquidity, or simply called internal liquidity, to start seeking internal liquidity. So you expect it to come down, take out all these lows, as many as it wants. When it has enough to power the next move to the level it wants, it will now move up. So in the process again of moving up, is creating internal range liquidity again.
Yes.
It creates more again. So after taking out the external one, it comes again to take the internal one and goes up again. Does this make sense?
Okay. Yes, it is.
Yes. So what we are looking for in the markets is liquidity. What we are looking for in the market is liquidity. Now, apart from all these major liquidity I've highlighted, same highs and same lows. With
Yes.
same highs and same lows, we can also be almost like your support and your resistance. This
Okay.
liquidity, those are liquidity spots. Most times you see same highs and same lows. You see all these retail patterns, market structure patterns, chart patterns like what do they call the M shape and the W shape?
Yes, double top, double
Double
bottom.
top,
Yes.
double bottom, triple bottom, wedges and channels. They are all liquidity zones. They are all liquidity zones. So if you know how to identify valid liquidity sweeps or liquidity grab around those patterns, you can you can formulate a good trade setup that will be that will be profitable for you.
Yes.
So there are also some other major liquidity. Let me use another chart. There are also some other major liquidity, like we call them time-based liquidity.
I never heard of that.
You've never you I think you have, but you've not taken note of the name. Time-based liquidity. Time-based liquidity. Call them time-based liquidity. Let me expand that a bit. So we are looking at things like, mm, let's see, we're looking at zones like previous, I use that word, previous, previous day high,
Oh,
previous
okay.
day high, things like previous day high and previous day low, previous day previous day high and previous day low. We also have previous week high and low. Previous week low. We also have previous months. So these are important liquidity zones in the market because you see traders marking out these places and putting orders there. Previous month's high. And we have previous month's low. So these are zones in the markets that price reacts to. We also have sectional highs and lows. Sectional high, sectional highs and lows. One section that is always targeted by retail traders or most traders is the Asian section high and low. The Asian section high and low. Let's look at an example of this session high and low. You can see my charts,
Yes.
the way I marked it. I took a trade today where I was targeting the Asian low. I was looking at the Asian, I marked out the Asian session low and the Asian session high. I marked out the Asian session low and the Asian session high, and I was waiting for a trade entry. Yeah. So this is the Asian session. The Asian session always starts by 8 p.m. Eastern time till midnight, 12 midnight Eastern time. So after that time, you mark the high, the highest high, you mark the lowest low. So every time price sweeps liquidity off the high or the low, you can buy or you can sell. So in this case, I waited for price to sweep liquidity off the Asian low. And the moment I got a change of character, I looked for a position to place my entry. I looked for a position to place my entry, and boom, I went on. I left it. I just targeted the 1 to 2, and that was it. I will teach you how to take this entry, but that's not what we are looking at now.
Okay.
We're just looking at the type of liquidities. So so we have the Asian session high and low. We have the which other one do we have? We have
The
New
the
York
sec.
section. We have New York section. We have New York section high and low. So you can decide to mark each session's high and low.
Okay.
Session high and low. And so, but one common one for traders is they mark the previous day high and low, especially what do I call it? Day traders. Day traders like marking previous day high and previous day low. Look at this, for instance. I do it too. I do it too. When I want to take a quick scalp, I go to my daily time frame. I go to the daily time frame. Let me look for a clean chart. I don't want to touch all these charts I've marked. So you go to your daily time frame, for instance. Let me remove the drawings and look at the previous day. The previous day here, this is the previous day now. So let's zoom it a bit. You look at the previous day, you mark the high of the previous day, mark the high of the previous day, and your market slow. So you'll be waiting for a liquidity grab along this zone. So you can go to maybe your 1 hour, go to your 15 minutes and wait
It's
to
just,
and
it's
wait.
just one candle, right, for the day.
Yes.
Okay.
Today is a new day, for instance. Today is the market has already started a new day, Tuesday. So like on Tuesday, you mark the Monday's candle, Monday, which is the previous day. You mark its high
For the
and you mark
previous
its
day.
low. Yeah.
Okay.
That's why we say previous day high and low. So you mark the previous day high and low. The high here is 91,365. Let me get it right. 91,365. 565. Let's be accurate about it. And its low is 9769. 9769. 69. So, so after marking it, you go to 15 minutes. That's what I prefer since you are day trading. So what are you looking for? If price comes low, takes out this low and gives you a valid liquidity sweep, you take your entry, you buy and target this low, or you just simply target a 1 to 2. Target this high, or it's just simply target a 1 to 2. Or if price decides to come here first and sweep this high, gives you a valid change of character, you take your 1 to 2, you take a sell. That's what some traders do. And I think that strategy is simple enough. It's a very, very simple liquidity trading strategy. But you still
Yes.
understand some nuances. There are some few things you need to understand: how to identify a valid liquidity sweep, how to identify a valid change of character, then how to identify the zone you are buying from, the demand zone you are buying from. Is it an order block? Is it a fair value gap? Then you target a 1 to 2. So, so those are the types of liquidity we have in the markets. So we have the time-based liquidity. We have the time-based liquidity. This thing no one work for me. We have the time-based liquidity, the previous day high, the previous day low. Then we have the previous week high and the previous week low. Let's see a case of previous week low. Let's use NASDAQ, the NAS 100. Let's see what happened last week.
Okay.
Let's mark last week low. So this is the last weekly candle. We mark his high out. What's the value of that high? It says 2665.8. 2665.8. 2665.8. Okay. We also mark the low. Also mark the low. The low is 19,888.5. 19,888.5. 888.5. So once you mark that, you can now go to maybe your 4 hours, your 1 hour, even your 15 minutes. All you have to do is you don't do anything until you see a sweep here or you see a sweep here. You get it? You don't
Yeah.
any action until you see a sweep here. When you see a sweep of the low, you want to buy after a market structure, after a change of character. When you see a sweep of the high, you want to sell after a change of character. But most retail traders will do the opposite of this. Once market sweeps this low, it breaks down. They are thinking of selling.
Yeah, the change of character
Yeah.
that can be a pullback, right?
Yes, the change of character can be a pullback. So once they see that this market breaks this low down, they want to sell. But you are thinking of the opposite of what they want to do. So yeah, once they see market breaks the structure to the upside, they want to buy while you are thinking of selling after you see a change of character. And most preferably, after market goes out, you want to say market come inside this zone again, gives you a change of character, maybe with an order block of fair value gap. Then you take your sell, target a 1 to 2, or if you're ambitious, you target this low again. So that is it. So we'll resume again in the next 6 to 10 minutes. Then
Okay.
you how we identify what are the things we use to identify this valid sweep. So for now,
Oh,
we've known where to look for the liquidity sweep.
okay. All right.
We'll now see how to really identify them. That's what.
Oh, okay.
So I'll see you in the next 10 minutes.
Okay. All right.